Sometimes it feels like you're just drowning in information, doesn't it? Especially with something like crypto.
Oh, absolutely.
1 minute it's NFTs, then some new blockchain, then bam, a math and regulation drops. It's really hard to sort the signal from the noise.
It really is. The whole digital asset world moves so incredibly fast. Trying to figure out what's actually, important versus just daily chatter. It feels like a full-time job sometimes.
Yeah.
That's why just summarizing stuff, it doesn't really cut it.
Yeah.
You've got to dig in, figure out the why and so what does this mean for me?
Exactly. And that's precisely why we're doing this deep dive today. Welcome, everyone.
Glad to be here.
Our mission today is to take this foundational piece of EU law regulation 2023-1114, most people call it MiCA, markets in crypto assets, and really break it down for you.
Yep.
We want to unpack its main goals, get clear on how it sorts different crypto assets because the categories really matter. Look at the rules it sets for, everyone involved, and most importantly, how it's designed to protect you, the person participating in the market.
Think of it as your guide to understanding this huge piece of regulation without needing a law degree.
Hopefully. So let's just jump right in. The big picture. Why did the EU feel the need to regulate crypto now? What's really interesting, I think, is that the regulation itself doesn't just come out swinging,
No, it doesn't.
It actually starts by acknowledging the potential upside of crypto.
That's a really crucial point. The text actually calls them digital representations of value or of rights. Yeah. And it's quite positive about the potential.
Right.
It talks about innovative and inclusive ways of financing, especially for smaller businesses, SMEs, and for payments. It mentions cheaper, faster, and more efficient payments, particularly cross-border stuff, because you cut out the middlemen.
So it's not just about clamping down.
No, not at all. It feels like they're trying to harness that potential, not just control it, which, is maybe a bit different from how some other places first looked at crypto.
That's a great way to put it, harnessing it. But, okay, despite seeing all that good stuff, the regulation also points out a pretty big problem, right?
Yeah, a fundamental one. A lot of these crypto assets, they just didn't fit neatly into the existing EU financial laws.
So a regulatory gap.
A huge gap. And this is where it gets, quite direct. The document says point blank that a dedicated and harmonized framework wasn't just nice to have, it was necessary.
Necessary. Wow.
Yeah. Without clear rules across the board, all that potential could easily get lost in, instability and risk.
So what are the main goals of this necessary framework then?
It's pretty comprehensive. They want to support innovation, fair competition, make sure retail holders like you are protected at a high level, keep the markets honest, that's market integrity, and promote overall financial stability.
Okay.
Plus, smooth payments.
Yeah.
And even helping the crypto companies themselves, the service providers, scale up across the EU and get access to banking services, which has been a real headache for many.
That is ambitious. Are there guiding principles behind this?
Two main ones, really. First is same activities, same risks, same rules. Basically, if a crypto asset acts like a stock or a bond that's already regulated, it stays under those existing rules.
So avoids doubling up.
Exactly. Keeps things consistent. The second principle is technology neutrality.
Meaning?
Meaning they're not trying to regulate, say, blockchain technology itself. They're focused on how it's used the assets and services built on top of it. That's key for letting the tech keep evolving.
Okay, that makes sense. Focus on the application, not the underlying tech. But it sounds like MiCA covers a lot. Is there anything specific it deliberately doesn't cover?
Yeah, there are exclusions. A good example is digital assets you just can't transfer to someone else.
Like loyalty points.
Exactly. If you have loyalty points you can only spend back with the company that issued them, and you can't sell or give them to your friend, they're generally outside MiCA scope.
Got it. So transferability is key.
It seems to be, yeah.
Yeah.
The focus is on things that could function more like financial instruments or ways to pay.
Okay. Now, MiCA is clear on what it doesn't cover, but you mentioned earlier it looks at broader impacts too, something about the environment.
Yes. This is quite forward-thinking, actually. The text explicitly mentions the principal adverse impacts on the climate from certain crypto consensus mechanisms.
Like Bitcoin's proof of work.
Like proof of work, yeah. And it actually requires companies to identify and disclose these environmental impacts. That's pretty notable for financial regulation.
Definitely. And what about the global picture? Crypto doesn't really respect borders.
No, it doesn't. And the EU recognizes that. The regulation states support for international efforts, trying to get different countries on the same page with crypto rules, convergence, they call it.
So not acting in a vacuum.
Right. It's framed as part of a bigger global push for clarity.
Okay, we've got the why, the big vision. Now let's get into the what. How does MiCA actually define and sort of slice and dice these crypto assets? Because you said the categories are crucial.
Absolutely crucial. It's like biology, you need to classify things to understand them properly. MiCA basically sets up three main categories, and it's all about how they aim to keep their value stable.
All right, category one.
Category 1, e-money tokens, or EMTs. The definition says these are crypto assets that purport to maintain a stable value by referencing the value of one official currency.
So like a token pegged to the euro or the dollar, perhaps?
Exactly. Think stable coins, but specifically those tied one-to-one with a single official currency. Their main job is likely to be payments, functioning a lot like the electronic money we already have.
So if I'm holding a euro pegged to EMT, it's basically like having a digital euro I can spend.
That's the idea, yes. And for your protection as a holder, these things can only be issued by outfits that are already regulated as credit institutions or electronic money institutions.
Okay, so established players.
Right. And here's a key safeguard for you. You have a direct contractual right to redeem your EMT at any moment at par value directly from the issuer. Meaning your €1 EMT should always get you exactly €1 back. No ifs, ands, or buts. That redemption right is fundamental. It's what really anchors its value.
So that sounds like a solid protection. What about the money behind the token? Is it safe?
MiCA is very specific here. To make sure your redemption right is real, a big chunk of the funds backing these tokens, at least 30%, must be kept as deposits in regular banks.
Okay.
The rest has to be invested in really secure, low-risk assets. So yeah, the idea is your digital euro is backed by a very solid, very tangible safety net.
Good to know. Anything else on EMTs?
One more thing. Issuers can't pay you interest just for holding EMTs.
Oh, why not?
It reinforces their role as a payment tool like digital cash, rather than an investment that earns you yield. Keeps the focus clear.
Okay, makes sense. What's category 2?
Category 2. Asset reference tokens, or RRTs. These also aim for a stable value, but instead of referencing just one currency, they reference another value or right, or combination thereof.
So this could be like a basket of currencies or other assets.
Exactly. Maybe a mix of currencies, maybe commodities, maybe even other crypto assets, though the rules get tighter there. It's broader than the single currency peg of an EMT.
Okay, so potentially more complex. What are the safeguards here for holders?
Two big ones jump out. First, a general duty. Issuers must always act honestly, fairly, and professionally, and in the best interest of the holders. That's a core principle.
Sounds good, but how is it enforced?
Well, the second big safeguard is much more concrete.
Yeah.
The rules around the reserve of assets. This is the pool of assets backing the RT.
Like with EMTs.
Similar, but with some key differences. This reserve must be legally segregated from the issuer's own company funds. Totally separate.
Why is that segregation so important?
Because if the issuer goes bankrupt, that reserve pool is ring-fenced. It's meant to be there to cover obligations to you, the token holders, not the company's other creditors.
Ah, critical protection in a crisis.
Absolutely. And who holds this reserve is also tightly controlled. It has to be custodied by a regulated entity, could be a bank, an investment firm, or even a licensed crypto asset service provider.
Yeah.
And those assets must be unencumbered, meaning readily available.
Okay, so third-party oversight, what about how they invest that reserve? Can they just put it anywhere?
Definitely not. Just like with EMTs, but maybe even stricter, the reserve for RTs can only be invested in secure, low-risk assets with minimal market concentration and credit risk. Again, safety first.
And interest. Can art issuers pay interest for holding the token?
No, same rule as EMTs. No interest allowed just for holding the RT. Reinforces the idea that it's a reference asset, not primarily an investment-seeking yield.
Right. EMTs pegged to one currency, RDs pegged to a basket or other things. What's the third category?
The third one is basically everything else. It's the catch-all category for crypto assets that aren't EMTs or RDs.
So like Bitcoin or
Right.
Ether or utility tokens.
Exactly. This is where things like standard cryptocurrencies would likely fall. And the regulation specifically calls out utility tokens.
What makes something a utility token under MiCA?
The definition says it's a token only intended to provide access to a good or a service supplied by its issuer. So think of it like a digital voucher or an access key for a specific platform or service.
Okay. So it's not trying to be money. It's trying to be useful within a specific ecosystem.
Precisely. And because their function is different, The rules for these other crypto assets, especially utility tokens, are generally less stringent under MiCA.
Less stringent how?
Well, especially if they're given away for free, maybe as a reward for network participation, or if they can only be used within a very limited network of shops, the full MiCA requirements might not apply.
But that doesn't mean it's a total free-for-all, right?
No, absolutely not. It's really important to remember, even if a token falls outside some of MiCA's specific rules, general consumer protection laws still apply, so there's still a baseline level of protection.
Okay, that's a really clear breakdown of the types. So knowing these categories, what does MiCA demand from the companies actually, creating and offering these assets or providing services around them? Let's talk about the gatekeepers.
Right. The issuers and the crypto asset service providers, or CASPs.
Let's start with issuers. What's the deal with this crypto asset white paper I keep hearing about?
The white paper is absolutely central. It's a mandatory document if you want to offer a crypto asset to the public in the EU, or if you want to get it listed for trading.
And what's in it? Is it like a prospectus for stocks?
Kind of, yeah.
Okay.
It has to contain really detailed information, and crucially, it must be fair, clear, and not misleading.
About what specifically?
About pretty much everything relevant. Who's offering it, who the issuer is, details about the project, the crypto asset itself, what rights or obligations come with it, and very importantly, the risks involved.
So it's supposed to be the go-to document for anyone thinking of buying in.
That's the idea. It's meant to give you, the potential holder, the information you need to make an informed decision.
But, and this seems like a big but, there's a disclaimer, isn't there?
A very big, very prominent disclaimer.
Mm-hmm.
It has to be right there on the first page, stating clearly, this crypto asset white paper has not been approved by any competent authority in any member state of the European Union.
Okay.
And it adds, the offer of the crypto asset is solely responsible for the content of this crypto asset white paper.
Wow. So the authorities check that the white paper exists and has the required sections, but they don't actually approve the content or vouch for the project.
Exactly. It's purely a disclosure requirement. It puts the burden squarely on you to read it critically and do your own homework. The authorities aren't giving it a stamp of approval.
That's a really important distinction for people to understand.
Absolutely vital. The white paper also can't promise future value. No guarantees on price increases. And it needs to be accessible, in an official EU language or English, and machine readable so systems can process it.
Okay. Beyond the white paper, what else do issuers have to do? General conduct stuff.
Yes. General obligations include acting honestly, fairly, and professionally, communicating clearly, and managing any conflicts of interest properly.
Conflicts of interest? Like if the issuer also runs the trading platform?
That kind of thing, yeah. They need to identify those potential conflicts, try to prevent them, manage them if they arise, and disclose them clearly. Transparency is key.
Any specific rights for retail buyers?
Yes, a significant one for initial offerings. If you, as a retail holder, buy a crypto asset directly from the person offering it, you generally have a 14-day right of withdrawal.
Like a cooling off period.
Exactly. You can change your mind within 2 weeks. However, this right doesn't apply if the crypto asset has already been admitted to trading on a platform.
Ah, okay. So it's mainly for that initial sale phase.
Correct. Still a useful protection for those early purchases.
Now let's switch gears to the other side. The service providers. The CASPs, you mentioned exchanges, custodians.
Advisors, portfolio managers, anyone providing a service related to crypto assets as a business.
What's the main requirement for them?
Authorization. Plain and simple. You cannot legally provide crypto asset services in the EU without being authorized as a CASP.
And is that authorization country by country?
No. And this is a huge deal. Once a CASP gets authorized in one EU member state, that license is essentially passportable. It's valid across the entire union.
Wow, okay. That must make things much easier for businesses wanting to operate across Europe.
Huge advantage. Fosters a genuine single market for these services.
What are some of the key conditions they have to meet to get and keep that authorization?
Well, for starters, their main headquarters, their place of effective management, has to be physically located within the EU.
Boots on the ground?
Pretty much.
Yeah.
And like the issuers, they have that core duty to act honestly, fairly, and professionally, and in the best interest of their clients. Standard stuff, but important.
What about information and risks?
They have to provide clear, fair information, not misleading stuff. And they absolutely must warn clients about the risks involved in crypto assets. No sugarcoating allowed. Plus, transparency on fees they have to publish their pricing policies.
Makes sense. Do they need to have, capital reserves,
Yeah.
financial buffers?
Yes, they do. They're subject to what are called prudential requirements. This means they need to hold a minimum amount of capital.
How much?
It actually varies depending on the type of service they offer. There's a schedule in the annexes. Simpler services like just giving advice have lower requirements than, say, running a big trading platform or holding customer assets in custody.
So it's proportionate to the risk.
Exactly. It can be a fixed minimum amount or sometimes a percentage of their overhead costs. And they might be able to use an insurance policy to cover part of it too.
Okay. And what about those CASPs handling custody, holding on to people's crypto for them? That seems high risk.
It is. And the rules reflect that. Custodians are generally liable if client assets are lost due to things like ICT failures, cyber attacks, theft, basically anything within their reasonable control.
Unless
Unless it's proven to be an external event beyond any reasonable control. But the default is they're responsible. They also have strict rules about safeguarding ownership rights and keeping client assets totally separate from the firm's own assets. Segregation again.
Very important. Anything specific for CASPs running trading platforms like exchanges?
Yes, they need rules to prevent listing crypto assets that have inbuilt anonymization functions.
Yeah.
Privacy coins, unless the platform can still somehow identify the holders and the transaction history.
Trying to clamp down on anonymous transactions for illicit finance reasons.
That seems to be the clear intention, yeah.
Yeah.
Enhancing market integrity and traceability.
That detail you mentioned about the varying capital requirements based on service type, that really shows the thought that went into this. It's not just a blunt instrument.
It really does. It shows they tried to tailor the rules to the actual risks posed by different activities within the crypto ecosystem. It's quite a nuanced approach.
Okay, so we have rules for issuers, rules for service providers. What about rules for the market itself? Keeping things fair, preventing manipulation.
Absolutely. MiCA directly tackles market abuse. It includes measures against insider dealing, unlawfully disclosing inside information, and market manipulation.
These sound like terms from traditional stock markets.
They are essentially adapted for crypto. MiCA defines inside information quite carefully.
How so?
It's defined as information that's precise, hasn't been made public yet, relates to an issuer or a specific crypto asset, and crucially, if it were made public, it would likely have a significant effect on the price.
So stuff a reasonable holder would likely use to make investment decisions.
Exactly, that phrase is in there. That's the benchmark. Clarity on what counts as inside info is key for preventing its misuse.
And if an issuer has this kind of information, what's their obligation?
They have a duty to disclose it to the public as soon as possible. Make it public knowledge quickly and effectively.
Can they ever delay disclosure, maybe if it harms a negotiation or something?
Yes, there's a possibility to delay, but only under strict conditions. It must be likely to prejudice their legitimate interests. The delay itself can't be misleading to the public, and they have to be absolutely sure they can keep the information confidential during the delay, and they still have to tell the regulator about the delay later.
Okay, so it's a narrow exception, and using this info is obviously banned.
Completely banned. Engaging in insider dealing, trading on the info, recommending others trade based on it, or unlawfully passing it on, all prohibited. And market manipulation, things like spreading false rumors or executing trades to create a misleading impression of supply or demand, that's banned too.
Standard market integrity stuff, basically.
Pretty much. Aiming for a level playing field.
So who enforces all of this? Who's the referee on this playing field?
It's a multi-layered system. The front line, day-to-day, is the national competent authorities, the CAs, in each EU member state.
So the national regulators.
Right. Each country designates one or more authorities. They handle the authorization of CASPs, the supervision, receiving the white papers, and enforcing the rules within their own country.
And they have real teeth.
Oh, yeah. They have broad powers. They can demand information, conduct investigations, inspections, and if they suspect rules are being broken, they can suspend or even prohibit services, offerings, or trading activities.
Okay, national level. But you mentioned EU bodies earlier, too, EBA and ESMA.
Correct. The European Banking Authority, EBA, and the European Securities and Markets Authority, ESMA, play a really important coordination and oversight role. They help ensure consistency across the EU.
How do they do that? And what about transparency for the public?
Well, for transparency, ESMA maintains several public registers. You can go online and find lists of all the crypto asset white papers submitted, all the authorized RT and EMT issuers, and all the authorized CASPs across the EU.
That's useful.
Very. And ESMA also keeps a public list, a kind of name and shame list of companies that are providing crypto services illegally without authorization. a clear warning sign for consumers.
Okay. Now, you hinted before about significant assets getting special treatment. How does that work with supervision?
Right. This is probably one of the most interesting structural parts of MiCA's supervision. If an asset reference token, RT, or an e-money token, EMT, grows really large based on criteria like number of users, market cap, cross-border activity, it gets classified as significant.
And what happens then?
Then supervision responsibility actually shifts from the national regulator.
Up to the European level.
Exactly. It shifts directly to the European Banking Authority, the EBA.
Wow. So the EBA becomes the direct supervisor for the biggest stablecoins, essentially.
That's a good way to think about it, yes. For those designated as significant, the EBA then sets up colleges of supervisors, bringing together relevant national authorities and ES to ensure coordinated oversight. But the EBA leads.
And does the EBA get more powers when supervising these significant ones?
Yes, it gets direct powers. It can request information directly from the issuers, conduct its own investigations, do on-site inspections.
So really hands-on supervision.
Very much so.
Yeah.
And the EBA can impose supervisory measures directly on these significant issuers if they find problems, and even levy quite substantial fines or penalty payments for infringements.
And I think you mentioned earlier the EBA actually charges these significant issuers fees to cover the costs of supervising them.
That's right. The cost of this enhanced supervision is borne by the supervised entities themselves. Creates a funding mechanism for robust oversight.
Makes sense. Are there any other big powers these EU bodies have, maybe in emergencies?
Yes. Both ESMA for the general crypto assets and EBA for ARTS EMTs have what are called temporary intervention powers.
Sounds serious.
It is. If they identify significant investor protection concern or a threat to market integrity or financial stability related to certain crypto assets or activities, they can step in and temporarily ban or restrict the marketing, distribution, or sale.
So like hitting an emergency brake.
Pretty much. It's a powerful tool designed to let them act quickly to protect consumers or the market if something looks like it's going seriously wrong.
Okay, wow, that's a lot. We've covered the why, the what, the who. So wrapping this up, what does this incredibly detailed MiCA framework really mean for you, the person maybe holding some crypto or thinking about getting involved?
I think the main takeaway is that the EU has taken a really comprehensive, proactive, and frankly, quite nuanced approach here.
It's not just one broad stroke.
Not at all. It distinguishes between different types of assets, sets clear and often demanding rules for the companies involved, and builds this multi-layered supervisory system with significant powers.
So the goal is?
The goal seems to be twofold. Allow innovation to continue, yes, but within a framework that brings much-needed clarity, robust consumer protection, and safeguards for financial stability. It's a huge shift from the largely unregulated space we had before.
The end of the Wild West in Europe, maybe?
That's certainly the intention, I think, to establish clear rules of engagement, build trust, and make the EU a, well, hopefully safer and more predictable place for crypto activities, with a strong focus on protecting you, the end user.
It definitely sounds like a landmark piece of regulation. It makes you wonder. And maybe this leads us to our final provocative thought for you to consider. Given how comprehensive and frankly influential this EU framework is, how might MiCA's approach ripple outwards and influence how other major markets around the world decide to regulate crypto? And what kinds of new opportunities or maybe even challenges could this create for the future of digital finance, both inside and outside the EU's borders?